Hello, this is Mike Swanson, and you're listening to the Wall Street Window podcast. However, in a few moments, what you're going to listen to is a recording of an interview I did with Iossif last Friday for his show, in which we talked about the financial markets and similarities to what is going on now with this recent rally taking place in the markets and what we experienced in the summer of 2000 and also the fall of 2007. A lot of people are getting into stock trading for the very first time, and there are opportunities in the markets to make money and things breaking away from the stock market. Gold has done that, for example. However, we're still in a very risky situation for the broad market itself, and that's what I talked with Ike about. So one quick commercial break, and then on with the discussion with Ike Iossif, who runs the website marketviews.tv.
Humans. Their nature demands competition, the rising tide of aggression shaping the world around us. Natural fear and disgust can overcome the ability to reason. Coping skills are left wanting. Carmine Savastano, Human Time Bomb, The Violence Within Our Nature, poses significant questions and considers the evidence that violence shapes the past and present. Human Time Bomb, The Violence Within Our Nature. Order your digital and print copies now on Amazon.com. For more information, visit tpaak.com. Carmine Savastano, Human Time Bomb.
Welcome to Market View with Ike Iossif and friends. This show that not only reveals and analyzes the inside story on today's market news, but also uncovers the areas where investors can make money right now. Market Views with...
Good morning. Mike Iossif, your host for Market Views. Yes, my very good friend, Mr. Mike Swanson. Hi, Mike. How are you?
Oh, I'm doing great, Ike. How are you?
I'm doing well, too. And, Mike, I was looking forward to speaking with you today because, you and I have been friends and talking on the air for many years. And for both of us, the first big bear market that we experienced in our careers was the 2002 bear market. And I must say to you that although the circumstances are very different, and in fact, the circumstances we're facing now are much more dire than in 2000, the initial sentiment, the initial reaction is eerily similar to what I remember from 2000. For example, yesterday, over at the CNBC, I heard two comments that were exactly the same, like the ones I was hearing back in the spring of 2000. All of us agree that the market will be substantially higher by the end of the year. Another comment: I think the market has reached the bottom. All of the bad news has been priced in. It sounds so similar to what they were saying in April and May of 2000. One simple, silly question that I have is this. Well, everybody agrees that the circumstances now are different and more dire than in 2000, also in 2007. The bear market that ensued after 2000, 2007 experienced declines of roughly 50%. So my simple question is this: if the circumstances are more dire, why this bear market will come to its full conclusion after registering losses of only 33%? If the previous two ones, under less dire circumstances, came to conclusion after registering 50% loss? I think it's a fair question, isn't it?
Yeah, for sure. And I want to get back to your 50% thought, but I want to tell you something real interesting about the sentiment. Well, first of all, I've got both me and you, or you could say we're sort of in the financial media on the internet at least. And I do advertising to generate leads on my email list, done a lot on marketing over the years and so forth. And twice I went to a conference that was put on by Agora for people in the financial publishing world. And they canceled it this year because of the virus situation. Instead, they have done some presentations with people, Agora, for those that don't know, they are a financial publisher. They sell newsletters, memberships to financial websites. They're the biggest company in the business. They spend millions and millions of dollars probably every single day on advertising. And the presentation I watched yesterday was how one of their divisions are reacting to what's happening and what marketing messages are working. And they can test all these different messaging, right? And the person said that messages about a bear market or crashes or something are not working, and the promotion that's working the best that they are testing is something called America 2.0. And the premise of it is that this is just a small speed bump, and the market is going to bottom out. The market is going to rally back up, and we're going to have a new boom, sort of like what happened in the 1990s. And we're going to have a 1999, repeat or something. So it's a very bullish thing. And they were saying that what the messages people seem to want is talk that things are going to be back to the way they were or even better. And to me, this is completely crazy and in denial. Two things, what I see, you mentioned the 50% level, and historically, I have a book called This Time is Different, and then Ray Dalio has a 3-volume set about bubble or debt busts, which I think this is what this is. And both of these books show that historically they analyze every single bear market that's linked to debt problems, including 2008, serious bear markets or financial problems, and almost all of them declined 50%. Not 30%, and most of the bear markets actually last 12 months or 12 and a half months, 16 months, somewhere in there, not just 2 or 3. And secondly, another bear market that I experienced was the gold bear market from 2013 to 2016, and I wasn't invested at the top of it. And I didn't even start to try to buy until 2014, and I still lost a nice chunk of money, I put it that way, by not even being in the final innings of the bear market. And to me, that's a message. It's best to wait until you're sure it's over with. But also the way the market is broken down off the high, and we're still way below the 200-day moving average, reminds me, as far as the price action goes, to gold stocks in 2013, which would mean, we're getting a bounce now, but the market could hold in there for weeks or even a few months. But I just assume it'll probably make another leg down before the end of the year.
You're making a very good point, and people who are listening to us, I hope they take this away from this interview, if not anything else. One of the trademarks of bear markets, most of the damage is done near the end. I think people need to be careful, because if there's still another 10-20% decline from current levels, if you own individual stocks, those individual stocks can experience a much larger decline than they already have.
Oh, for sure. And it's shocking, when it happens too. The thing about the way this one is started is it's the way it fell. It wasn't like the 2000 bear market or the start of the one in 2007. in which the market, fell about 20%, then rallied back up, and then rolled over. So you had a lot of time to figure out what was happening. This time, the market topped out and just plunged down 30%. But not only that, the bond market also fell apart, and both those things, such a shocking decline. Even during 1987, the stock market crashed. The market fell to the 200-day moving average and bounced back up. And in the 1929 crash, it did something similar. This one fell even faster initially than during those two declines. And the 1929 bear market, interestingly enough, high-yield corporate bonds actually went up during that crash. And then in 1930, in the summer, they went into a bear market. But this time, they fell with the stock market. So I'm not trying to imply that we're going to have a bear market that lasts for 3 years and the market's going to fall 90% like what happened then. But this is a serious financial situation, and the Federal Reserve has responded accordingly with zero rates, unlimited quantitative easing, and these are extreme measures that would imply that there's something really serious going on. And a lot of the talk, I'll go back to that promotion called America 2.0, but I see, it on the internet and in the news media, there's a lot of talk that things are just going to go back to normal, and I just don't think that's really going to happen. I think we're in some sort of stock market, bear market, and an economic situation that when it's over with, it's not going to last forever, but we're going to be living in a different society and maybe form of doing business. And the Great Depression caused a lot of changes. You were in a different world 10 years later. So, I don't know, what necessarily even are the best stocks to buy if you're planning out 10 years ahead.
I also think decisions have to be made based upon not what the market does, but upon the investor's individual situation. If you are 30 years old and you're investing having a 30-year time horizon ahead of you, then perhaps it's a good idea to start nibbling in. But if you are 65 and you're just about to retire, perhaps your criteria should be a little bit different. You have to consider how old you are, what your investment goals are, and when are you going to need those funds.
Yeah, that makes a lot of sense to me. A big challenge I also think everyone faces now is historically in the U.S. stock market, a good investment strategy has been to put a good chunk of your money in stocks and then a good chunk of your money in bonds. And historically, if you were 50-50 invested that way, bonds go up when the stock market would decline and you get interest. But now we're in a bond bear market, even if the Federal Reserve prints money to prevent Treasury bonds from declining in price. There's no value in Treasury bonds because the 10-year bond doesn't even yield 1%. This is a huge challenge to navigate your financial situation if you can't put money in bonds in a rational way. So I think that's going to make it so gold is the answer to that problem. I believe that at the moment we're in some sort of huge recession in the United States. The forecasts are real dire. Some of them for 30% contraction in the gross domestic product in the first 6 months of the year from Goldman Sachs. I mean, others are projecting like 15%. But either way, these are dire projections, and they're causing deflationary pressures in the economy where people are having to sell things to raise cash if you have a business or you want to get rid of your debts and things like that. But at some point, these deflationary pressures are going to end, And I think we're going to have a lot of inflation as a result of all these Federal Reserve and the U.S. government stimulus programs. We're going to have a busted budget. So gold is going to benefit from that. And I think that makes gold a necessary investment for people. I mean, right now, I think that's the simplest thing to do. You know, even though I'm bullish on mining stocks, the gold itself is trading less volatile than the stock market, and I believe it's going to go up more than the stock market over the next several years. Whereas all stocks, I think, you know, and I'm not really bearish on the mining stocks, but many mines are shutting down. The situation of the virus is disrupting just about every business in the world at the moment.
Mike, anything else you'd like to add?
You know, sort of in a lockdown where I live, most businesses are closed. I think it's a third of the American population is in that situation. Much of all of Europe, I guess, is. And I think people are kind of getting stressed out and anxious and from everything going on. And I think people not only have to take care of their health, but their mental health, and be able to think clearly about what's going on in the markets. And because there's, like we were saying, there's a lot of people just I think it's some sort of denial to just keep predicting everything's going to go back to the way it was. And that doesn't mean you have to go the opposite and just get really depressed or something. I think you just have to deal with the markets as well as you can and adjust to what's going on. And there will be opportunities out of all this to do all kinds of stuff. You know, even if the stock market goes into a bear market or continues a bear market for longer than people expect, there will be things to trade. Some things will benefit. I think, as I mentioned, gold, but I think other commodities will go up, and none of this is going to all happen in a day. So you can be really patient and watch and look for things, even though this initial decline has happened so suddenly that very few people were able to benefit from it or adjust to it. I think going forward, we'll have more time to do that. So that's one good aspect, I think, that will be a little different going forward.
Mike, thank you. Have a great weekend.
And you too in there too.